Hey guys, Rich Trading here. Today I wanted to show you guys how I myself am making 20 to 30 to $40,000 months, and how you guys can do the same thing. Um, I don't normally show my P&L. I don't usually show my exact income, but for transparency reasons and to show that I'm a profitable trader, I wanted to come on here and show you guys. I don't want to show my bank account information, but this is how much I've made this month. This is on my bank. Okay. So, just showing that for transparency reasons, so you guys know that this isn't just bullshit, and this is actually how I make a living. So, I'm gonna be going over the A plus setup that I take every single day, or whenever it presents itself, a couple times a week, whatever it may be. This is usually what I trade. This is like 90 to 95% of my trades. I have a few other models I use, but this is the number one model that I use for making, $40,000-$30,000 months. Cool. In order, these are the confluences I use. I kind of have it labeled in terms of like what my setup needs to see, what I need to see to even enter a trade, and then kind of extra confluences I also look at to help with bias and help with confidence, and just kind of to let me kind of know if the trade is higher or lower probability. So first thing needs to be a high time frame liquidity sweep. There needs to be a high time frame PD array underneath or above the liquidity sweep, depending if we're long or short. And then we need to see a lower time frame shift in order flow. So that could be a CISD, a change in state of delivery, or an IFEG. Those are the main two I look for. Could be a breaker block, but those are the kind of the biggest two I look for. And then bonuses is I'm obviously also looking at SMTs between ES and NQ. I don't really watch the YM. That's just me. I know a lot of traders use YM also for smart money reversals, but I don't. And then also I'll look at low time frame order blocks. And then obviously you need a target. So when I'm looking at targets, I'm going to be looking at the opposing resting liquidity to the other side that I'm taking the trade, as well as obvious unfilled gaps. That's kind of a term that kind of might be confusing to some people. Like, what do you mean by obvious? I'll get into that in a little bit, and hopefully it'll make a little more sense. So, for this example, we're going to be looking at Thursday. What is this? September 18th. Okay. So I have I'm using replay mode just to make it easy, so it's simple to go back and forth. And you can see here on ES and NQ, we're at the same time. Big thing on this day, what I would be looking for is we have on ES a gap right here, right? This is a hourly high time frame gap. It could be a 4-hour gap. It could be a 90-minute gap. It could be a 1-hour gap. It could even be like a 30-minute gap. That's high enough time frame. Daily gap. But I like using the 1-hour. I like using the 90-minute, the 2-hour. Those kind of really fit my strategy the best for looking for high time frame gaps. And then obviously we need that high time frame liquidity. That's also in the confluences that you need to see. So yeah, we have sell side here, and then we have sell side here. Okay. So what makes this a high time frame liquidity is we have a high, a low, a higher high. This is going to be that resting liquidity, and you look back, high, low, higher high. This is that next liquidity, and this is the sell side that I'm going to be looking at mostly when taking this trade. I'm going to be looking for a push down into the sell side, and the biggest thing I'm looking for here is a reaction. I'm looking for a reaction back up, something that I can get on that I can get on side with on the smaller time frames. Now, if this candlestick just decides to go and close underneath here, nothing. I'm not trading that day most likely. close underneath this gap, does not fit within my criteria. We still have liquidity, but we're not reversing off that high time frame gap. So I'm going to sit on the sidelines for the rest of the day. Now, it's important to look at this on ES and NQ. For me, I trade ES and NQ. I know a lot of people will only trade NQ. Typically, because of the way price action is, 80-90% of my trades are on NQ, but I'm always looking at both to decide which indice is the better trade to take. So we go to NQ. This is this 6 a.m. candle is this 6 a.m. candle, and you can see here we have two gaps. So what I do when we have two back-to-back gaps like this is I will either do something like this, where I'll just make it one bigger gap because they're back-to-back, or I'll hop on like a 2-hour chart and see if there's just one gap, or a 4-hour chart. So nothing really there. This 2-hour is kind of ugly. Maybe the 90-minute. So the 90-minute is the best here. So here we have one clean gap on the 90-minute. So on the 90-minute for NQ is what I would set for the gap. And then on ES we have a nice clean 1-hour gap, okay? Now, it's important to realize that this gap is this one. So NQ is not trading as low as ES here, right? This gap here is this one here on NQ, right? But they're both trading into a gap. And what's actually really bullish about this, which is why I chose this as my example, is because while NQ might look like it didn't take any liquidity, ES did. And because one indice took liquidity, that means there's actually an SMT here, which is just another indication that there's probably going to be a reversal. All right? So if you go from this low to this low, and you go from this low to this low, there's a divergence here, okay? So that's kind of what I'm looking at when I'm looking to take these trades, okay? Is looking for that SMT divergence. That's going to be in the, right here, extra bonus, smart money reversal, right? We're looking for that SMT, cool? So now we have step, high time frame step complete. Now we're going to hop into the lower time frame. We'll start the 5-minute on both. And now we'll get into what actually qualifies this for a legitimate trade, or what would discount it in terms of why I took the entry, or why I would take the entry. Okay. ES comes in, make a low, come up higher, we dive deeper. Now this is really what you want to see. You really want to see one push down, a tracement up, and then the push lower, right? When I'm looking to take trades, I really like seeing reversals that do this, and then we can take this entry somewhere in here. I don't like taking entries, that do this, right? This is much less probability because we didn't take this low. When we get the secondary sweep of the low time frame, this is going to be much higher conviction, okay? So that's another thing that I'm always watching for when I'm looking at smaller time frames, okay? So we see here, ES and NQ within their respective gaps. We have the SMT that's from here to here. Okay. Now what am I looking for the entry? We can hop in on a 3-minute chart here and see what this looks like. Beautiful. On the 3-minute chart, we do have this fair value gap here that gets inversed on ES, and on NQ, we see the same thing. Okay. Now you see that these are two separate gaps. So again, I'm going to be looking to see if I can make this into one gap on the smaller time frames. And the best way to think of it is when you're looking at IFEGs, you want to be looking for the highest time frame gap on the last trading leg before the reversal, right? So what that means is we have, this is the last leg, right? This final push down before we start to reverse. Cool. Right here, final leg. And now I'm looking for the highest time frame gap of this leg, right? So if you look at the 5 minute, there's no gap here. So we can't go any higher than this. So now I'm going to go from the 5 to the 4 to the 3 to the 2 to the 1 and try to find the highest time frame gap. Where is it? Where is it? It's the 4 minute gap on ES and NQ. So what I would do is go to the 4 minute gap, and this is what I'm going to be looking at. The 4 minute fair value gap, here and here. And you can see we get up, we close above, we retest it, and then we take off. We get above, we retest it, and then we take off. Cool. Now, where is the entry? Why did I enter this? You know, there's a lot more to this than just IFEG, enter, where's the stop loss, these kind of things. So whilst I am going to use this gap for my bias and for my change in state delivery, I am also obviously going to look at the 1 minute. I do want to make sure there's no kind of bearish price action up here, or some 1 minute gap here that's alone. That kind of looks gross in a way. So yeah, so on this trade here, while we did close above on the 4 minute, we do have this little tiny 1 minute gap that did reverse off of. However, when I'm seeing something like this, and I know that we're getting this rejection off a high time frame gap after sweeping liquidity, we have a 4 minute IFEG, I'm not going to be too concerned about this 1 minute gap holding. I'm going to stay true towards the upside. And that's going to take much higher precedent than this one little tiny 1 minute gap. If you're always looking at any teeny tiny bearish PD ray on smaller time frames or bullish PD ray, that's going against you, then you're never going to end up taking a trade, because you're always going to be able to find something that might potentially go against you. But it's important to use the context of the higher time frame, of the reversal, and of everything else you're looking at to kind of judge what the trade is most likely going to do, okay? What the price action is most likely going to do. So on this trade here, there's two ways you can look at it, right? You can either say, okay, lower low, low low, we popped off the high time frame, sell side here, gap here, closed above, and you can either go ahead and do your long position here on the closure of the 4 minute, targeting up here with stop losses down here. Right, and we'll get into the target and the stop loss later. So you can either do something like this, or you can, after the 4 minute closes, you can hop on the 1 minute and look for where you can get in on a retracement. Cool. So now here we can look for a standard FEG. So we have this 4 minute gap. I'm just going to get rid of that for now, just so it's more clean. And now we can look at this 3 minute FEG. Why do they use the 3 minute? Because 4 minute doesn't have anything. So that means 3 minute is the highest time frame FEG of this trading leg, right? As you can see, we pop down into this 3 minute FEG and we race higher. So you can set your long position within this FEG towards the top of it to make sure you get your entry, stop loss under that candlestick, and then targeting highs to the upside. Okay. Now, couple things to talk about here. If you are going to use the system where you enter simply off of the IFEG, this is completely fine. There's nothing wrong with doing this, right? You're just gonna enter here, targeting like here, and putting your stop loss somewhere underneath. Right? There's nothing wrong with this. Now, benefits to this is you're gonna get more entries. You're not gonna miss trades. It's not gonna run without you because you're entering on the closure of a candle and you're not waiting for retracement. So that's a positive. Negatives is you're gonna have more risk, right? Because you're entering a lot higher. You're not waiting for a retracement. Now the retracement is not guaranteed, but it's gonna give you a better risk to reward, and it's gonna give you more potential for a higher point trade. So that's kind of just something that you have to kind of tinker around with, back test what you like to do. Me, myself, it really depends on the trade. Sometimes if I'm really bullish and I'm seeing price action really kind of expand and I don't think it's going to retrace, I'll just hop in on the closure of the IFVG. And sometimes I will wait for the retracement and enter off of an FVG or something like that. Maybe just like the 50%, maybe just the 50% of the range, something like that, just to give myself a better entry, right? So that's kind of up to you. Maybe it's just you don't want to risk 50 points on a trade, like this would be a 68-point risk. Maybe you don't want to risk that much, so you go ahead and you put your entry down here, and you're okay with potentially missing out on this trade, right? Those are important things to think about when you're looking at taking trades like this. Cool. Now, how do I decide whether I'm going to take ES or NQ? Generally, it's pretty simple. All I'm going to do is usually trade the more bullish. If I'm taking buys, I'm going to be trading the more bullish pair. If I'm taking sells, I'm going to be trading the more bearish pair. If we go to the hourly, you can clearly see ES dumped a hell of a lot more than NQ. NQ held a lot better. Therefore, ES is going to be the more bearish pair, and NQ is the more bullish pair. Therefore, I'm probably going to be taking NQ buys. Cool? Because I'm taking NQ buys, this is what I'm going to be looking at. I'm going to be putting all of my attention now, or most of my attention, on NQ. So assuming I'm waiting for this, let's say we're going to assume that I took buys at the closure of the 4 minute gap here. Okay? So right here. At whatever, it's right here. Cool? Now where's my stop loss going to be? Some people will just put their stop loss right underneath this IFVG. Closure above means they're out. Me, I like to look at it a little bit more in depth. I'll go to the 1 minute or the 2 minute, and I don't like the idea of price coming down and filling this 1 minute gap and then reversing, stopping me out before reversing. So when I'm taking a trade like this, I'm always going to be putting my stop loss underneath the gaps of the trade leg that I'm taking the buys off of. So if this is the lowest part of the gap, I'm going to put my stop loss just underneath this, somewhere around here. Also, you can see we have a bullish order block here, added confluence that I want to make sure I'm putting my stop loss underneath this order block. The last thing I want is for price to tap into this order block, stop me out, and then rip back up. So I want to make sure I'm giving this room to not stop me out and allowing for this order block, these FVGs to fill, and not putting my entire stop loss on just the IFVG itself. Cool. So now we established where the stop loss is going to go. Now where's my take profit? Take profit is where I like to really use ICT kill zones, pivots. So London highs had already been swept. However, if these London highs had not been swept, I would definitely put my take profit at these London highs. Because they've already been swept in this trade, then I'm going to most likely target, we need at least a 1 hour, right? So if this is my stop loss at 69 points, I need to be targeting the highs up to here. Cool? We can look left. This is actually trading at all-time highs, it looks like. So this would be my full TP here. Generally, I would look to trim right, on the way up. But because it's such a large stop loss in points, I would de-risk size. So instead of maybe using 1 mini, if that's your standard size of 1 mini, I would maybe use 5 micros with a larger point stop loss, and then just go in for a higher point take profit. That makes sense. Now, if your entry was down here on a retracement, now your 1-to-1 is right here, and you could actually take a trim right here and then targeting up here. Now, regardless of whether or not you're taking trims, no matter what, I'm putting my break even to here. So once price reaches this, I'm going break even, risk free trade. Now I'm targeting the highs up here. Okay. Now the last thing I'm looking at mid trade. So those are the main two ways I'll manage my trades. The last and final way I will manage my trade. Oh my god, I'm all messed up. The last and final way I will manage my trade is obviously by looking at ES. So this high is at 527. This high is at 527. So if I'm targeting the same highs on ES and NQ, I'm going to trim whichever one hits first. So this hit at 710. This hit at 725. So because NQ took the high first, I would just get out when NQ hit. But assuming, let's say, ES took this high first and NQ was like right here, I would trim my position or get out fully when ES took the high. The last thing you can do is, if you didn't want to take full profits here, is sometimes I will wait. I'll take 75% of my position when this gets hit, and then I'll wait and I'll put the rest of my position to exit up here. And as you can see here, that never came, so you would have most likely gotten 75% off at the top and then break even, or let's see how this plays out on NQ. And you would have gotten break even, or you might have probably had to just exit at the end of the day for this. Yeah, end of the day you would have just gotten out for a couple points at the end. So, you can trade it. Your take profits can kind of vary, but the simple way to do it is just target the next buy side liquidity. So yeah, the last thing I will do sometimes is look at gaps. If there's the obvious gaps, is what I'm looking at, are things like this, right? Gaps above highs. So we have a high here, right? High is here, and this is the next obvious gap above the high. So you can take a trim here if you're above a 1-to-1. If not, then just go to break even. I'll never trim for less than a 1-to-1 risk to reward ratio, but I will put my stops to break even before 1-to-1 if it's at an area where I think it could reverse and mess up the trade. But yeah, that's all I got. This is the trade setup and trade system I use for 90-95% of my trades. The only other trades I take are continuation trades for if I see accumulation, manipulation. So accumulation, manipulation, distribution. And if I miss this initial push up and we don't take highs yet, for example, like this did it immediately. But let's see if I can quickly find an example where we don't take highs. Let's see. Let's turn this off really quick. Let's see if I can quickly find something. So overwrite. Okay, so let's hop into this right here. So let's say I'm bearish bias for this low here, and let's say I missed this initial morning move, and I'm still looking to hop on side shorts to get lower, that's when I will look for a sweep and then redistribution lower. So I'll be marking out highs, obvious highs like here, obvious highs like here, obvious highs like here, right? And I'll keep marking these until I see something that sweeps and we get that initial reversal. So here we sweep, cool. No IFEG. We start pumping back up, so I'm still looking out for this high to get swept. We come back lower, and this IFEG, you can see here, we test it twice and then get a bounce down. And here's an area where you can hop on side with a short, somewhere in here. Likely this is not a trade I'd be taking. It's a little too risky for me, but you can kind of see the thought process that I'll be looking at through here. There's a lot of other examples I'm sure I could find where it's a lot cleaner, where I'd actually probably take a trade. If this was me, I probably would miss this because I would want to see, I'd want to see it kind of come back a little higher and retest a little higher into here, and then maybe I take a short up here with a smaller risk reward, or with a smaller risk, and then take this all the way down to the lows. But you can kind of see if the thought process is, if we fail to sweep a low or a high, and I want to hop on side, I'll wait for a turtle soup. So this is the turtle soup here where we sweep and then we get lower. So that's the only other trade setup I will look for, is if I miss the initial reversal, like if I missed this, and if I missed a short somewhere in here, and I see obvious lows that we're probably going to sweep for that day, I will look for that turtle soup where we come back up, sweep a previous high, and then try to hop on side with a short back to the downside. Hopefully that helps. I would really just focus on the first setup I talked about, and if you miss a trade, move on to the next day, study it, look at, like, after the day is over, look at what you might have missed, how you could have entered it, if there was a trade up at all, a trade setup at all. A lot of times there's some days there's no setup, and that's okay. It's okay to sit cash. Sitting cash is a lot better than taking a loss and forcing a trade. Hopefully this helps. I'll see you guys in the next one.